All right, here we go. So good afternoon, everybody. Welcome to our live show. This is our first episode of Wealth Wednesday since we took a little hiatus a few months ago and when there's been some big changes here at Commonwealth. And we actually have a show dedicated to what has happened over the last several weeks. I'm joined right now by Nikki Ludy, who's a certified financial planner professional in Woodsfield, Ohio. Joining me here shortly will be Vince McManus, one of the financial advisors in our Parkersburg office. I'm Neil Watson, a certified financial planner here in Marietta. Nikki, thanks for joining me today. Been an interesting first half of the year so far.
Yes, absolutely, Neil. It's been kind of a roller coaster, but the good news is the roller coaster seems to be still going uphill right now. Year to date, we've seen the S&P 500. I mean, is up almost 11% year to date.
Right.
Dow's pretty flat. Nasdaq is up quite a bit.
Yes.
But overall, I feel like we're moving in the right direction, but it's not been in a straight line to get there, and it's not guaranteed to be a straight line to end the year either.
Right. Yeah. It's been a challenge, and it's been up and down. And read something the other day that most of the gains in the S&P 500 have come from just a small handful of companies. It's been the top 10 names, which are mostly technology companies, which would tie into what the NASDAQ is doing as well. And I know that when you have those indexes that drop a lot, they tend to bounce back quicker, at least have that immediate surge off the bottom more so than the ones that didn't drop as much. So that's been kind of a interesting development of that as well. One of the things I think that people lose sight of is that volatility is two sides, right? It's down, which worries everybody, and up. How are you talking to clients about that particular mix of what volatility really is?
Well, I think for most people, the extreme sides of this volatility, like you said, you can always have the volatility upwards, but we don't get client calls about that. But it's just getting people to stay the course and understanding that there's no magic solution to this. Looking back just a few months ago when this banking crisis came up, it was a lot about just waiting for the dust to settle because the market tends to go in a complete frenzy as soon as news appears, and you just have to give it time to kind of settle out before you really know even what's happening. And I think the last year has really been a testament to that we just need to sit back, take a breath. This is not, just losses in a client's portfolio. It's only a loss if you sell it. You really just have to take a step back, understand how much risk you're taking, and where do you want to go from here. If you're in your 30s and your account is down 20%, that's, in my opinion, that's not a case to panic, but in, some cases, this knee-jerk reaction to volatility, like the sky is falling.
Yeah.
No offense to our media, but they just keep it coming every day.
Absolutely. That's one of the biggest enemies we have, right? Is the news media just tends to really glom on to all of that negativity, and whether it's money or anything else, it's always about sensationalism and hyperbole. And really what happens is that the real stories are behind the 2-minute sound bites that we get on the news media. Welcome, Mr. McManus. We're glad you could join us today. Vince, a financial advisor in our Parkersburg office, joins us here for our live stream today. Vince, first half been a pretty interesting year for you as well, hasn't it?
Yeah, I think it's just been an interesting, interesting year for everyone, and that's the thing with markets. It's always different this time, except it's actually always a little bit the same, and it's kind of the driving force and what we think that we help people deal with is there's always going to be something that's going to be challenging in markets, and it's going to be the soup du jour of whatever's next. So we just finished the debt ceiling, which I don't know if you guys know. I'm surprised to be sitting here in this chair today. But somehow we made it until the next big thing, which we'll probably make it through that too.
Yeah.
So.
Right. So you'd sent me an interesting chart, Vince, and I wanted to ask you about this a little bit. You had a performance spread, monthly performance spread between the NASDAQ and the Dow Jones Industrial Average from 1971 to 2023. And for the last month, the Dow Jones was trailed the NASDAQ by 9.29%. And the key thing in this chart was when that had happened before. Can you give us a little bit of description about that?
Yeah, I can. I'm a little bit going off of memory here, but most of the time, I believe every time that had happened before was sometime ranging from the mid to late 90s, early 2000s, which in our industry is kind of known as the tech bubble, which again, it replays on my idea that the history doesn't repeat itself, but it often rhymes. And it's just some of the same themes that we've continued to see. If you go back to, kind of this was before our time. Maybe it was your time, Neil. Really hard time here, but about the Nifty 50. That was the hot growth stocks of that day. And you just tend to see these things start to repeat themselves in patterns in some way. And then this time is different, and it's probably not. I'm not saying it's going to be as bad as the tech bubble, but I would say that, like if I was thinking of buying NVIDIA 2 months ago, I definitely probably wouldn't buy it at today's prices.
Yeah.
You may be happy for a few years. I don't know when it'll switch, but even if they were the best company in the history of the world, it'd be hard to justify that price any more than like 10, 15, 20 years out.
Right. So, Nikki, I know one of the things that I'm often asked by clients is what's your outlook for the rest of the year, and it's impossible to predict. In fact, I have a little prop on my conference room table. It's a crystal ball, and I think I'm buying a Magic 8 ball here before too long. Things like valuations historically are a little bit higher. Are you sharing with clients that you're somewhat guardedly optimistic for the short term?
Yeah, I mean, what I share with clients right now is really that, we might read, 15, 20 different articles, and they're all predicting different things. And so at the end of the day, we've seen this upswing in the market, but like you said, valuations are still fairly high. So no one is willing to predict what the next thing is going to happen. I think the biggest thing that I try to pose to them is number one, that the Fed increasing rates. Once they're done with that, I think that will give the market much more clarity, and I think we're closer to the end of that. But even when it comes to interest rates, we don't know. Are they going to continue to go up? Are they going to? I've read articles that think they may go down by the end of the year, and everything in between.
Right.
So it is a very cautious. We're still being very cautious in what we're doing, but I think the message is the same: is long-term growth. We're not looking to get out of the ballpark. If that happens, great. But overall, staying within your risk tolerance, understanding that there's one-hit wonder stocks that have just soared this year. It's what everybody's looking for. If
Right.
it was that easy, and we all had our Magic 8 ball to do that, we would do that. But it's not that simple.
Right.
So I just really try to get clients to focus on risk, and what that means, because even if we think the market's going to take off, it's probably not going to be in a straight line. And so really just honing in on asset allocation, understanding that honestly we don't have to take a lot of risk right now. There's a lot of opportunities in the bond market that didn't exist a year ago or 2 years ago that can help steady the portfolio and still get decent returns. And if equities, still continue their upwards trends, great. But if that doesn't happen, I still, think that people need to be cautious in what's happening, because, people always want to dive in when the market's doing what it's doing right now. They never want to buy when it's low. And I think that's, they're fooling themselves if they think it's, just a simple win for the year.
You bring up a good point about the bond market, and Vince, this is something we haven't seen probably in 5 years or so, and interest rates have gone up, and that did some damage, as we all well know, from last year. But it gives us something to look forward to as we move on, right?
It does, yeah. I mean, again, it's last year was probably one in a 100 year type year for the bond markets. It was just really insane. Yeah, you could forecast it a little bit, but and everyone did so supposedly with hindsight, even though they really didn't. Which again, that never changes. But the idea that you can find some compelling opportunities in fixed income right now. But really, like on the overarching picture, like kind of playing off of what Nikki was talking about, this is why we're so planning focused in what we're trying to do, because the market is always going to feel crazy over a short time period. That is a feature. That is not a bug. That's why you can make these great long-term returns. But you have to really be able to take a wider angle and view things from a long-term perspective. And that's why planning is so important, because we don't want to be making these reactions to market moves, whether they're great, which like the Nvidia is going crazy right now, or when they're terrible. If you have a 2009 or last year in the bond market, things that don't usually happen. We want to be a steady ship, navigating through our life. That's the only way to really get those nice long-term returns that we're looking for, and to build out an income stream throughout the rest of your life through retirement. That's what we're going for, and the only way we do that is by focusing on a plan and being disciplined and being smart, and not getting too far out either way, whether that's when times are good or when times are bad. I like what Nikki said, because I always say that this is the only industry where when things are on sale, people don't want to even come in the door. They're running away. A thing I use a lot with clients is I'll use the analogy of, if you're driving past the Astorgado, and you see this nice big red truck that you like, you may pull in and say, "Oh man, that's too expensive." And then end of year sale comes in, and lo and behold, the thing's 20% off, and they'll just pull the trigger. We get those sales in the stock market, and no one wants to talk to me. The only time they want to talk to me is when the truck's is at the highest price they could possibly be.
Well, they want to talk to you, but they don't want to talk about good things when that sale
Yeah,
happens.
they want to
right?
talk to me, not about buying,
Right.
about
So
how we have to jump out of the shit.
So let's shift away from the investment side a little bit. I know that's a popular topic that everybody wants to talk about. Nikki, the planning work has not stopped over the first half of this year. What are some of the better opportunities you've seen as you've worked with clients on their plans? What are the opportunities that are presenting themselves for people to take advantage of things?
Well, I mean, I just think overall, just long-term planning. I think last year, just with where the markets went, it was an opportunity to sit down with clients again and help them revisit the original plans that we looked at, to understand that, um, like it or not, we're going to have another market downturn in people's retirements, and probably multiple. So I've used the planning aspect of it, going forward, as opportunities to talk to them, about, what a drop in the market did to their portfolios. And most people were just fine. But the initial panic sets in when they see their statements. They think, oh my goodness, my account dropped by 10, 15, 20%. I'm not going to have enough money to retire. And what does that look like? But in reality, showing them that, this is not a loss per se, this is a short-term setback, and helping them to see, kind of where that goes, going forward. There's also been opportunities, I think for a lot of my clients, taxes are a big question. So, encouraging people to set aside money in Roth IRAs and Roth 401ks, and showing the planning opportunities that if you really think the taxes are going to go up in the future, this is a way to benefit from that, especially for young people right now. And I think the key behind it too is just showing them that saving, and increasing their savings every year, is going to give them the best opportunities down the road for achieving a healthy retirement. I think everyone thinks it's all behind the investment side, but it's really the systematic saving over time and getting to that goal of retirement. Because the reality is, you're not going to, sell all of your equities on day one of retirement and go into a CD, but that is the thought process sometimes.
Right.
That people think, they need all that money in one lump sum. But I think the more and more people sit down and focus on what the real goal come down the road. So I personally feel that saving more for my own retirement rather than letting someone else do that for me is probably going to
Yeah.
be something that people are going to have to think more and more of. So it's not, you know, there's lots of opportunities for, lots of different planning tools and things like that, but it's specific to each person's goal. But I think saving, understanding long-term goals, not being unrealistic, honestly. Some people don't put a lot of thought into retirement, and come when it's a little bit too late, and you're trying to squeeze blood out of a turnip, and that's not not really how you probably want to spend your retirement days, worrying about money at that point.
Right. Vance, I read an article here not too long ago that the 5 to 10 years before you retire are probably some of the most important. When you're working with people in that time window, what are you seeing? What kinds of tactics are you suggesting that they evaluate? How does that factor into the planning side of things for you?
Yeah, for me, one of the bigger things I come across is I'm trying to build in flexibility, right? Like we don't know I don't know what's going to happen the next minute from now, let alone what people in Washington are going to do 5 years from now, 10 years from now, 15 years from now. I don't know what's going to happen to clients health-wise 5, 10, 15 years from now. So I put an extreme premium on flexibility, right? And trying to take again a forest for the trees approach and saying, hey, how do we structure this so we're not just looking at a number on a screen, right? I have $100,000 in my IRA. What does that mean? It's more of how do I structure my assets in a way that allows me maximum flexibility to deal with life. Life doesn't stop happening when I retire. It happens just the same. And for most people, you're gonna just psychologically be a little bit more nervous because you aren't working anymore. We tend to get more risk averse as we get older, just psychologically. So we try to build as many things in to deal with those I guess known unknowns that are most likely going to happen. So I'm pretty big on having asset location diversification is one of the biggest things I talk about. I think it's imperative that you go into retirement and you have some assets that are in traditional IRA, traditional 401k, some that would be in Roth 401k, Roth IRA, some in taxable brokerage. We make sure that our cash reserves, that's probably the first part we even think about. If that part's
Right.
not right, I can't be a good investor. It is
Right.
literally impossible. I've
Right.
never met a single person on earth that can do it. And I see people come here all the time and they don't have enough to deal with, a major car repair, but they convince themselves that they're going to be able to be good investors. It can't happen
Yeah.
because there's just too many factors that we are out of our control. And we want to focus on the things that we at least have some semblance and ability to control a little bit, and then be smart enough to understand that there are some things that are outside of our control, educate on those issues, say, here's what we've seen historically, here's how we've dealt with it, but hey, we don't know when that's going to happen, we just know it will. And build that flexibility in there. I mean, the key word I say that I'm dealing with again would just be flexibility. Some
Nikki,
other things that we could do, oh, sorry, is
no, go
just
ahead, please.
within like, depending on what someone's tax rate is, we really pay a lot of attention to that because that's a key thing that we look at and say, hey, we could forecast it's going to be X in 10 years. We try to get out in front of that train and do some things such as Roth conversions, or again, invest in a taxable brokerage account. Everyone tends to love dividend stocks. When you say, hey, we have all three types of these accounts, in my taxable account, I want as few dividends as possible because I want to control that. I want my dividend stocks maybe in my traditional IRA since they're going to be taxed higher anyways. We kind of just playing games around with that stuff can add a lot of value over a lifetime to where even if we have the same return on paper, if we structure this stuff correctly, we're actually allowing clients to keep a lot more of that money in their pocket and allowing Uncle Sam, their unnamed business partner in their life, to get less.
Unfortunately, Uncle Sam's going to get, especially if you have an IRA, it's getting some of it.
He's going to get something. We just, we don't know what his partnership interest is, but I'm a big believer in trying to make him as limited of a partner as
No
legally
doubt.
possible.
no doubt. Nikki, in the last few months, we've been working with one individual in particular, and there's some inertia here that he's struggling with the idea that making that transition from having a reliable paycheck to building an income stream out of what he's worked very hard to save. How do you help people overcome that mental obstacle, even when there's enough?
Well, I think just drawing down, retirement assets in general, yeah, people tend to get very cautious because if that lump sum number that they start with on day one of retirement starts to drop, again, we go back to that knee-jerk reaction is they start to panic because they think that can never go up again once it does drop. So I think, the first thing I focus on is really looking at what people should consider a safe withdrawal rate, because sometimes when people come in and they haven't done the planning ahead of time, they have this number in their head of how much they need to pay the bills, but that might be 10 or 15% of the portfolio. Um, and that's a hard conversation because sometimes that means there's not enough coming in, and you either have to keep working at some capacity, or figure out how to make up the difference. Because if someone's portfolio is only going to last 10 or 15 years, that's probably pretty unrealistic. The other thing I go through with people too, back to kind of Vince's point, is the taxation. I get an awful lot of people that think they have enough saved, like what you're saying, Neil, but it's all in a 401k or it's
Right.
all in a traditional IRA, and they haven't really thought out how to distribute that money after tax. Because if they need to, even if they're only taking distributions a few times throughout retirement, and they're not even relying on an annual basis, if they need to take out $30,000 to buy a car, they might need to take out 50
Right.
to net the 30, and that's something that I think a lot of people have not thought about, and that's when the reality I think sets in for some people,
Mm-hmm.
and the hard discussions of or paying down debt is another one that I get a lot. They want to pay down debt right before retirement, but then the conversation kind of turns to tax rate you're in. If you're in the 4 or 5 years before retirement, and in your usually peak earning years, is it even realistic to start taking this money? Number one, because it's going to draw down the dollar amount. So I think
Right.
it's helping people set expectations that they may be drawing, on this money for 20 or 30 years easily based on longevity, and trying to figure out a stream of income, a safe withdrawal rate, know what they have, or if it's not enough, what does that look like too, just to set them up for success long term.
Vince, we're going to shift back to the investment side of things, and not really what's been going on, but what is potentially coming down the pike since we've made a significant change. And we're going to have an episode next week with two of our partners that explain what really has changed here at Commonwealth. And it's a different world for us, and it's a new world for us. But there are some exciting things and interesting things coming down the pike. And one of those is called direct indexing. And that is an interesting opportunity. We also have some other income opportunities available as well. Don't want to really get into the details, but what are some other things that we're looking at from the investment side that we can maybe do that we didn't have the opportunity to do in our prior lives?
Yeah, to me, the biggest thing, and I'll really try to keep this big picture, is, one of the decisions that we've made to go this route was because we want to make sure that we have the most robust toolbox possible, I guess, so to speak. Again, a lot of that toolbox will never be used for a lot of people. We want to have the option to go through, and again, everything planning based and very specified to a specific individual and individual situations. But we want to be able to allow our people to use their brains, use their expertise, to come up with ideas, to serve clients in the best way possible, and then to implement those by having the best tools available, right? I mean, and I think very big picture here, that's what this change is going to allow us to do. It's going to allow us to serve clients even better than we were before, and that's always going to be the North Star of our firm. That's the whole point of this business. You know, we're fiduciaries. We work for clients to help them achieve their goals and make sure that their financial lives are set, and it's very much a partnership in that regard. And it's just personally, it's very important to me. Like when I'm working with any family, if you know, for example, if I can't get them to stay on the ship when we have market turbulence, like I have failed, period. You know, that is my goal, is to set them up to be able to make sure that they get through their financial life as anticipated. And again, I think having more tools only allows us to better serve clients and to better, you know, achieve that objective and help them reach their dreams and goals.
Nikki, you're kind of the chair of our financial planning committee. What exciting things are coming down the pike for us as we venture into the new world for us in the financial planning side?
Well, like I said before, you know, the focus of um, planning for a lot of people, or just even sitting down for a lot more clients to do financial planning. I think a lot of people take for granted that what they're saving and putting away is going to be enough, but they've never seen that on paper. So I think we want to expand the opportunities that when someone comes to us and wants to do investments, it's not all about the investments. It's about what's being saved. Is that going to be enough? What do the taxes look like 20, 30 years from now? And so we really want to hone in on getting everyone to do a financial plan and look at the bigger picture. Because like I said, I definitely found that in 2022, as we saw that market downturn happen, that's what we kept referring back to, is that people can't necessarily see just on the returns of their statements that their account balance is down, what that really does for them long term. And in some cases, they can withstand that market downturn just fine. And again, to what Vince was saying early, making sure that we build in flexibility, because there's going to be a lot of things that happen in people's retirement that we don't know when they start into retirement.
Yeah.
And so as those changes occur, we want to make sure that they're prepared for it. So yeah, we're really trying to develop something on the planning side that will show them in a manner that doesn't get too technical and doesn't require a lot of legwork on their part to show what's coming in, what's going out, what does this all equate to. I always like to use the phrase when people first come in, commercial that we used to see several years ago, what's your number?
Mm-hmm.
You know, everybody's number is different, that what they need in retirement, and that's what planning does for them, because without knowing what you spend, you know, what you make is not even really half the battle, in my opinion. It's what you spend. I have clients that, you know, spend six figures and think they have enough, and you know, it's never going to be enough to allow them to enjoy retirement. But as long as we can understand their bigger picture and what they're trying to accomplish, we can kind of show them, you know, what kind of flexibility we can build into that, and what kind of future their retirement holds.
Vince made an interesting comment. The toolbox here has gotten bigger for us. Whether it's the planning side, the investment side, the fact that we stepped into the registered investment advisory world just brought in the toolbox to be huge, and it's very exciting for a nerdy guy like me. So let's shift to something fun to close up. Nikki, I know you just got back from vacation and whatnot, and Vince, you both have younger kids. You know, my kids are my wife's 60 tomato plants in the backyard, and we babysit them. What's on the slate for the summer for you guys? A lot of ball games, a lot of stuff like that.
Yeah, for me, definitely we're into softball season and t-ball for my son. So we're hoping vacation last week. Did not have very much enjoyable weather. I hope it's filled with sunshine and things throughout the summer for the kids and family.
How about you, Vance?
Yeah, with us, we're in the process. We need to get our short term summer plan needs some work. But we're trying to plan a beach trip. I again, to me, like one of my biggest memories growing up was going to the beach. That's my thing. I mean, I listen to Jimmy Buffett all the time, anyways, and just I go to the beach. I listen to Jimmy Buffett. I listen to Kenny Chesney, Zach Brown Band, and a couple other Key West people. And I could never leave a chair as long as I'm in the shade.
Yeah.
Not tan very much.
Right.
But so we're working on getting that scheduled. We got some sports stuff. I have a wrestling camp with the boys coming up this week, so
Good.
that's going to be that should be interesting to say the least to see how my youngest responds to that. But they have some golf lessons and stuff, so
Good.
pretty full plate. But you know, looking forward to it. It's always a joy, but we've got to find a way to get down to the beach. This has to
Yeah.
happen.
For sure. So my exciting news: my grandkids move back next week.
Wow.
Their mother and them are moving back next week. Actually, I'm driving down to help driving that truck. So they're 3 and 1, and they are a lot of fun, and I'm just thrilled to death that they're going to be back in town. So, guys, thanks for joining us for this special live show. Wealth Wednesday will be back on schedule every Wednesday for the foreseeable future, at least till the Christmas holiday season comes up. Next week, we have Todd and Mike joining us to discuss what has changed, and then we'll have a full schedule going forward. If you would like to learn more about us and how we can help you, whether you live in Woodsfield, Parkersburg, Marietta, Wheeling, St. Clairsville, Athens, doesn't matter. We can help you. Visit us at cfswb.com. Thanks for joining us today.